for showing up to our press conference as usual, the post-MPC press conference. It's the last one of the year as far as we know. And so thank you for what's been a very busy but very successful year. I'll just go through our usual rules for those of you that have not been here before or those of you that are here for the first time after a while. How we conduct this is that the governor will run through his entire statement or submission or whatever word you want to give it all the way through, no interruption. Once he finishes, we'll then come to a Q&A session. At the Q&A, we will conduct it in a way that hopefully gets everyone asking their question. But when we get to that point, I'll let you know about how we shall do it. So for now, I want to invite the governor. Governor, please go ahead.
Thank you. Good morning, everyone. And again, welcome to this press briefing, press conference, post-MPC meeting. Today, November 26, 2019. But before beginning, I would want to express our heartfelt condolences for the damage, fatalities, and more generally the tragedy that has taken place in West Pokot over the last few days. And also for yourselves, I extend my condolences to you, because a member of your profession was cut down last Wednesday in Somalia. And obviously we offer our deepest condolences to you as well. So let's get to the substance of the meeting. I'll again go through the specific questions and or specific issues that came up in the context of the discussion yesterday by the MPC, that's the Monetary Policy Committee, and eventually the decision which you already know. So the first thing, the first item here is on inflation. As always, we begin with this because our mandate is first and foremost focused on price stability, price and financial stability. And inflation remains stable within the range, the target range. And in October, the CPI inflation was up at 4.9%, which compares to 3.8 in September. But this still remains around the midpoint, the mid of the range. So this obviously is not a concern. And this was despite significant increases in some food prices, tomatoes, maize and maize flour, peas and things like that, because of things that are specific to those commodities. Non-food, non-fuel, inflation remains stable. It is actually below 3%. It was at 2.6%. And fuel inflation also remains low and stable, in line with the trends in the domestic and international energy markets or energy prices. And this is despite upward revision in some pump prices this November 14th. And so we expect that despite that, we expect inflation and fuel inflation to remain modest. We can talk a lot more about inflation, but I think this is a well-rehearsed sort of territory, so I'll move on to the other things. The second element I wanted to bring to your attention is the situation in the global economic outlook. And this also you're familiar because we've had some conversations with you in other places. But suffices to say that the global economic outlook is really dire. Global economy is expected to grow by 3% in 2019 and then 3.4% in 2020 next year. And this follows continued downward revisions. These are IMF numbers, and they have been revising them. These last numbers were revised in October. And as I have said before, the rule of thumb, well, was, and for me still remains, 3% is the stalling speed for the global economy. So, and already you can see that the central banks in advanced economies have taken pause. They've paused the monetary withdrawal that was there and actually revised direction of their policy and actually are adding stimulus in the economy. So in their economies, you've seen the outcomes of their MPCs over the last few months, at least since October. That has been quite clear. Global economy has more hidden bad news, in that we have what we call a synchronized downturn. So all the economies are going down at the same time. It used to be that one could argue of a decoupling, where you have, say, the emerging markets are going in a particular direction and are therefore, let's say, stabilizing the rest of the global economy. Or for that matter, you have the US economy dragging the others away from recession. Now everybody seems to be going down at the same time. So this is quite worrisome. Now, the US economy is expected to grow at about 2.4%, which is quite low. China, 6.1%. But next year, China is expected to grow at 5.8%. It's the first time China is growing below 6%. So if this doesn't sound alarm bells, I don't know what will. We can talk about other things, but I think the uncertainties there are a lot of uncertainties, and we also don't know what trigger there will be for a downturn, a significant downturn. So not an interesting scenario, hence the assessment that the outlook is quite dire. So let's move back then to Kenya, but to move back to Kenya in the context of the external sector. And here again, I'll be quite quick. The external position continues to improve, and the current account deficit for the 12 months to September was at 4.1% of GDP. 4.1% of GDP compared to 5.1 in September of 2018. Now, we project the current account for 2019, the year, to come out at 4.3%. This is a deficit, 4.3% of GDP. And if you recall, some time ago, we talked about, we were expecting it to be around 4.5% of GDP. And actually, we had always said that in the medium term, 5% is of a deficit of 5% of GDP is more or less where we expect it to be. But anyway, we expect this to be at 4.3, and it reflects a narrowing of the trade balance, and you read into this the lowering of imports related to SGR, related to food, and also some key exports have been falling, unfortunately. We need to flag this. Tea, horticultures, and coffee. Those export numbers have not been strengthening, and there are issues that are specific to each of those sectors that need to be addressed. But also there has been some positive exports, or rather improvements, positive numbers, growth in exports, such as manufactured exports and indeed chemicals. So on the whole, the trade balance has narrowed, and it is a mixture of all those things I mentioned. Of course, services exports remain resilient. Transport, telecom, finances, and remittances remain strong. This we've been talking about. Actually, for the months through, I think we had October, there are only 2 months that had lower monthly remittances compared to the same month last year. So now, the growth rate is not as it was last year. Last year, it grew by something like 30% or some astronomical number like that. But I think the point is that the remittances have remained resilient, and I think we understand why that is the case. On the whole, also FDI has been quite satisfactory compared to the past. But I think what I would mention here is that in terms of financing of the current account deficit, there isn't any concern. fully financed by FDI, fully financed by other capital flows that are coming in, including, of course, portfolio investments that has been coming in. That means the foreign exchange market will remain balanced, and there should be no concerns in those markets, in that market going forward. So then moving on, banking sector. The banking sector remains sound and resilient. I'll just mention a few things about that. Again, this is well rehearsed. So first, liquidity remains high. Overall liquidity is something in the order of 51% in October. And it is across all peer groups, meaning there is liquidity across all peer groups. An interesting development here is that there has been larger, or should we say greater flows of deposits to the medium-sized banks. That was quite striking. And it is interesting because what this means is that the customers are responding to, let's say, services that are aligned to their needs. So if banks provide services or products that are aligned and whatever those customer relations, clearly the customers will respond accordingly. And this is what has happened. So it's an interesting thing in terms of if you ask the question whether bankers can actually learn a new thing, a new trick, and will customers also learn new tricks? Maybe these are not new tricks. Maybe these tricks have been with us, since Cain and Abel. But anyway, we leave that, or at least since banking was invented. So then, credit risk remains elevated, but this is easing. As was mentioned in the press release, NPLs to gross loans, the ratio, that has come down in October, marginally, to 12.3% from 12.6% in August. And yes, the areas that where decreases were noted was also flagged in the press release. I'm not going to repeat that. But suffices to say this has come on the back of repayments and also recoveries that banks are doing. If you recall, some time ago, we've been pushing this thing, banks have been pushing this interaction relationship with their borrowers, those that have NPLs, to try and let's accelerate or work with them and recover what needs to be recovered. There's no one-size-fits-all solution. It has to be done customer to customer, bank to customer. So it is hard work, but that's why they're bankers. That's why they wake up in the morning to deal with customers and where the customers are in that way. Operational risk in banks obviously remains, and therefore banks will need to remain alert. I think this is something that we all understand, and I think there isn't much to say there. There's nothing new except just saying that banks and everyone, including yourselves, need to remain alert. We could also say that there has been specific, let's say, campaigns, and there's one that I want to flag, which is a campaign to, let's say, educate or to remind customers about about security concerns, so that they can do what they need to do to minimize, to reduce their own risk in terms of not falling prey of all those marauding, let's say, crooks that are out there who want to steal your PIN, who want to trick you with some get-rich-quick scheme. Unfortunately, we've seen, and you have, I'm sure, been perhaps the first ones to see the very sad stories that some people have fallen into these sort of schemes or these traps. Finally, in terms of banking, the transformation of the sector continues, And I think here first we have the consolidation that we talked about before. Consolidation of the banks continue. And again, the reason for the consolidation, as we have said, is so that they can become more resilient. That's the objective. And have a much more resilient and stable business plan, or let's say business program, for the future, not just for the past. Not the past. I mean, something may have worked very well in the past, but they definitely need to refresh and have something that is aligned to the shocks that will come in the future and so forth. And here I think, just to remind you of the most recent ones, NIC and CBA, those happened just after our last meeting. And then we also have the KCB and NBK. That actually is quite interesting because it has been more than 30 years in coming. More than 30 years. I mean, there are people that were not born when the crisis started and the entire renovation, or should we say restructuring of NBK started. They are probably now working as employees in those banks. I mean, now you can imagine the damage it has caused to people and all those other things. It is important to appreciate that delaying these things causes a lot of damage. But anyway, that has happened, and I think it is important to flag it as a successful consolidation. A second element in the transformation in the sector relates to the repeal of interest rate caps that happened November 7. And here, I think there is a lot of maybe uncertainty, a lot of uncertainties from the perspective of the population. And I would want to remind and indeed emphasize to the population that this time will be different in terms of the way the banks will react. And we have explained that they are not going back to the same old ways of the past, the Wild West kind of banditry. No, they need to be responsible, and we have explained to them exactly how they need to be responsible. And it is our business to communicate this to the population, and so that they can realize that actually they should be number one with regard to banks, because banks should be becoming more customer-centric. That's the one thing, that actually they will be pricing their loans appropriately, meaning in line with my risk, right? And they have to assess my risk, not randomly, but in a sort of a structured way, so that they can say, I am more risky than the person next to me by this amount and so forth. And also other things related to transparency, that they will tell me what is let's say, what are they offering others, and what are they offering me. And gone are the times when they say, it's this, take it or leave it. And if you don't come back in 6 hours, this deal is off the table. That's sort of been, let's say, rushed into a decision, does not speak to customer centricity. And then obviously the last point, that they need to be more ethical, meaning ethical practices. And meaning they should be they should stay away from short-term gains. The focus on short-termism, this quarter returns, what is my bonus and things like that. And what will be the return to the shareholder, ROE, ROA, all that jargon that you are much more familiar with. No, they should be looking at things more medium term, and really thereby working to serve Kenyans. So banks should really be working to serve Kenyans because it's really Kenyans that have made, or rather that's why banks exist. It is to serve the Kenyans. It's not for other things. So that's really the bigger agenda, and I think we've already, started off on that journey. That has already left the station, as it were. And I'm sure you've seen some of the things that we've been putting out in various fora, and I look forward to engaging with you also as you engage with your own listeners and readers and so forth. So that's on the banking sector. I want to very quickly now move to the MPC survey. You know the survey that takes place before the MPC. It's really a market perception survey, or perception of people out there. And I just want to flag maybe 2-3 items, flagging them quickly. Inflation expectations are well anchored. That has not been a concern. It's important to repeat it. And also there is an expectation that credit growth will increase in 2019, mainly because of improved macro, acceleration of payments to by suppliers, or to suppliers, let's say, lending products that have now been unveiled or now been released, new innovative lending products to medium and small size enterprises, micro, small and medium size enterprises, MSME, the repeal of caps, all those were things that were flagged by the respondents of this survey. Optimism remains high. The level of optimism. Non-banks, their level of optimism is around 74% of respondents were optimistic or very optimistic about economic growth prospects. And that is actually lower than where it was in September. In September, it was 86%. But 75% is still a good number, 3/4. Banks also remains very optimistic, with 92% of respondent banks being optimistic or very optimistic. So I think the point here is all these are good numbers, I don't want to talk about forward bookings, but I think we'll be releasing this the results of the market survey soon, so you can look at it. But I think the numbers, they are good in terms of forward bookings in hotels and things like that. I want to talk a bit more now about the outlook on output. We received the data from Q2, and therefore we have completed, or we now have data for the first half of 2019. And the first half of 2019 grew, or rather GDP grew in the first half of 2019 by 5.6%. And really, for this compares to 6.4% 6.4% in the second quarter of 2018. I think I have given too many numbers now, and so let me just leave those there for now, okay? What I wanted to underscore is the following. So using the data that we have already in Q1, so the actual data Q1 and Q2, so the first half. And then we looked at the leading indicators these are the indicators of economic performance so far. So these are things like looking at imports of intermediate goods, and this show positive, or rather it correlates well, or it suggests that there's dynamism in the manufacturing sector. Manufactured exports are rising. The PMI index also show signals that there's positive activity in Q3. Other things, electricity and water, et cetera, On the basis of that, of all this, we have re-estimated GDP growth for obviously Q3 and Q4, meaning for 2019. And we've re-estimated this. Actually, it has come out at 5.9% in 2019, for 2019. This is really not different from 6% that we had a little while ago. We've been talking about 6% for some time. So 5.9 is really not different. I mean, materially, I assume that's the word you'd use, but we economists don't use materially. It's financial people that use that. So it's 5.9, which obviously is robust growth compared to, let's say, what's going on. And this is why I wanted to first flag what's going on in the global economy and so forth, and the numbers that are there. But be that as it may, this is not the end of this. We also did a much more robust check on the so-called output gap. There's a curious line in the press release, which, just for interest, I'll go back to it. It says, the MPC noted that inflation expectations remained well anchored within the target range and assessed that the economy was operating below its potential level. Okay, so I want to explain what that is about. So basically what we did is to get a good check on what we call the output gap. So what we did is, given current investments and, let's say, potential of production, excess capacity in plants, things like that, you ask yourself, how much output can the economy generate if all that excess capacity is used, right? What can the economy generate? And that defines potential output. So it's a thought experiment. So that is potential output. Now, it's not just a thought experiment. You actually ran some econometric estimations, and I'm glad to see some econometricians on our, in our MPC. The point is that is done technically, and you can actually come up with that estimate, and our team did this and in a rather robust way. Secondly, you then ask yourself, how far are you from this sort of potential output? So for economists, you could think of this as the sort of the production frontier. And so you're asking yourself, how far are you from that sort of production frontier? But the point here is that, how far are you? And basically, you calculate how much you're producing now and relate it to the potential, what you could be producing, as I mentioned before. Now, doing all that, we have calculated that the difference is what we call the output gap. So potential output would generally, in this case, be higher than where we are, all right? So we can produce even more because there's slack in the economy. And with this is what we then say that the output gap has been negative or is negative. We calculated it as negative, meaning there's that gap, you understand? Now, it may be confusing, but it is, even though it's confusing, I'll state it. At times, potential, or rather, your output is higher than your potential. You ask yourself, how is that possible? It just means that you are running in an unsustainable way. So the way you can run, let's say, the marathon, but you then move much faster, but you can only sustain it for a few hundred meters. But you cannot continue running the marathon at that pace. I hope you understand what I'm saying here, that at times that happens. This is not the case for us today. What is the case today is that we have a negative output gap, and we estimated this of something like 0.9% of our potential output, okay? And this was in 2019, this year. okay? So we can actually improve our production, our output, by a little more than 1%, okay? Now, we then tested this thing to figure out how robust it is. And we tested it in various ways by just looking at non-agriculture. You know, after all, agriculture very much may be running on the whim of some rain, right, or any of these things. So we tested that, and in the end, this is how we realized that, or the team realized that this was actually a robust estimate. You may ask yourself, why is it that in the past we were saying that it's about, the economy is about potential, is around the potential? And the answer is twofold. One is the robustness of the estimate. That's really the issue. It is important that we make decisions based on data, what the data, the evolving data is, not on sort of hunches and political imperatives or whatever other things that one may want to make those decisions. That's why central bankers are who they are. So I think that's important. I could also talk a bit more about some technical aspects of this output gap, but in the interest of let's say, time and other things, I'll just leave it there. Just to emphasize that there was actually an output gap, which was which showed that the economy can actually grow faster. Remember last time we had even been saying that it could grow even as much as 6.5%. Frankly, we are at 5.9, so that's around 6. And I told you that we are around 1% more or less output gap. So we can actually grow to around 7% without much problem on inflation. So when we talk about demand pressures are muted, that's what we are saying. We are actually saying that demand can increase without creating some sort of demand push inflation, yeah, or price push inflation. I don't know which way. Anyway, whatever. I think you understand. So that is really the point I wanted to make in terms of why is it that this was important. Now, noting the output gap, and also noting that the fiscal policy was actually less accommodative. It was actually it was going to. I mean, they were consolidating. So you remember we talked about the consolidation of fiscal policy. And their consolidation, if you look at the primary balance, it will be something in the order of 1.8% of GDP. So it is actually a substantial consolidation. So those two were more than sufficient reason for the MPC to go ahead and really adopt and execute what would be an accommodative monetary policy stance. So switching to that. That's really the point here. Now, it's true, the issue that has been on the table for some time is it's all fine for the Monetary Policy Committee to want to adopt an accommodative monetary policy stance. And in the past, we made the point that there was a problem in that we weren't sure whether there would be sort of a perverse reaction, and therefore what would generally be accommodative ended up being a tightening. Now, the advantage here is that the interest, and this was because of the interest rate caps. So the advantage now is that the interest rate caps are gone. So we know exactly the direction of accommodative monetary policy. And that's what we did. Now, having said that, the question is, obviously, we have not been using this sort of monetary policy approach for some time because of the interest rate caps. So will the economy remember how this works? And the answer is there has to be some relearning. Relearning of banks, relearning of consumers, so that actually we can have the correct reactions. So that is expected, and indeed, even from our perspective in the central bank, there'll be some relearning. We need to recalibrate our models so that we can tell you an impulse of X amount will probably lead to an X amount or X percentage of GDP over a period of 6 months or over a period of 2 months. Those sort of rules of thumbs have now been, let's say, messed up. And we need to go back to a territory where we now understand. But this is why we come to office every day. This is our business. So we now feel, in a sense, unshackled. The economy was running with, if you want to, an analogy about motor cars. So we were driving this economy with a handbrake on. And at the same time, there was somebody who was really pushing on the accelerator, i.e., the National Treasury, you know. And so we were trying to manage all this thing, mainly on the brakes, right? I know, you're looking at my feet, that's not proper. It's the brake on this one, not this one. But now there has been some sort of rebalancing, meaning the person who, from the fiscal side, there will be more, they'll consolidate, less accommodative, and we therefore can rebalance, be more accommodative. The handbrake has been pulled out, or rather has now been disengaged. And so the car now is in a much better situation. You can bring it to better balance. I want to say 3 things, and then I'll open the thing to questions. The first one is easy because it was, again, about interest rate caps. Just to remind you that this is an area where we have made our views quite well known about what we expect banks to do. I've now re-explained it in a nutshell. They are also, we will be publishing an op-ed in the various newspapers, and also yourselves will be open to other ways of communicating with you on this matter and other matters. The other one which I wanted to put on the table is there was a government circular that was issued earlier this month requesting all state corporations to surrender their funds to the National Treasury. I think you know the circular that I'm talking about. The question there, I think there are 2 questions which I want to answer. And the first one is, and to be very precise, they were requested to take whatever, if they had any, no, it's okay, it's not the circular, something else. They were requested to have, no, it's okay, yeah. They were requested to, let's say, surrender their holdings of treasury bills, investments in treasury bills, all deposits to the National Treasury. So from our perspective, the first question is, what's the impact on monetary policy on this? And I think I want to say that the discussion that you have been having has overblown this situation. Basically, the state corporations have holdings of about 5% of securities, T-bills and government securities. Those are the numbers that I forgot. They're on my desk, but that's the extent of it. So they're around 5%, actually at 5%. In October, it was 5%. So you can see it's not a large holding, right? Liquidating 5%, even if you did it in one shot, wouldn't shock the system, if you see what I mean. Secondly, obviously one should appreciate that even if it was 5% and there were concerns about impact on monetary policy, or for that matter, impact on the treasury bill market, obviously we wouldn't sit idle. We would actually work with National Treasury. We would coordinate and sort of say, hey, maybe we should do it this way or some other way. That way you'll maintain stability in the markets. So I just wanted to at least allay your fears, some of which have been written up in various places, that it cannot be that a decision like that happens and then there's chaos in the treasury bill market or government securities market. No, it is actually something that is not as. Remember pension funds. Pension funds have something like what? Is it 31%? Around 30%. So state corporations are small. That's one thing we need to accept. Secondly, for you to also know, when state corporations come to buy, there was the question, will they then alter the auctions, whatever that means, the pricing in auctions? Well, you should be aware that when state corporations come to the market, they actually don't go. They actually come to the we call it the non-competitive bids. They put in non-competitive bids, so they are not moving the market. So it is interesting. If you feared that there will be, just because they are there, the competitive side of the market will be warped. The answer is no, it won't be warped. So I wanted to put that to you. Then finally, there was a statement that we put out, a press release, about transfers of 4 billion from CBK to the Government Consolidated Fund. And obviously it was a very clear press release, so I don't need to talk too much about it, right? But maybe if I could give any. I think it should have been a very clear press release, but if you have any questions, ask me about it. But I think I want to make some points that are related to that. First, there were concerns by some of you that we also have been commanded, we as the central bank have been commanded to surrender T-bills that we hold. Sure, we hold T-bills, right? So just like who? Like Kenya Oil or any of the other parastatals, we are just thrown into this ring and we are forced. And that couldn't be farther from the truth or from the way things work. No, we don't quite operate under those sort of regimes. Our regime is very clear. The regime that we work with, there is a lot of independence and also in terms of relationship with other executives and things. And in particular, the only reason for us to hold T-bills is to do monetary policy. So, so to tell us one thing or the other doesn't make sense. What's even more is anyway, I don't want to go into all the rubrics, but I want to make a separate point for you. Bailouts by central banks have never worked. So if the government is short on, it wants to, like now they are short on revenues and they want to, in a sense, assort the central bank and grab whatever resources they are, right? That has never worked and it will never work. Such bailouts monetize the deficit one-to-one. And as you know, which means that the central bank prints money. It would be printing money to cover the deficit, whatever it is. And also it would draw the central bank as a conspirator in fiscal decisions, right? Whatever they are. And this, of course, will subordinate the central bank's key responsibilities to the fiscal decisions and political imperatives that are running, let's say, those fiscal decisions that have been made out there. However good they are, building roads, purchasing things for schools and all those are good, but that is not what should subordinate, that's not what should trump the responsibility of the central bank. So we have a term for it, of course, as economists we call it fiscal dominance, which obviously is a euphemism for violent assault on the central bank. I mean, you should see it that way, right? So I think that is something you should be clear about. And you should be afraid, very afraid, of what I would call, wolf in sheep's clothing. Those that, think that they can have something from the central bank and at the same time recover. Now, we are very fortunate, though, because there are sober minds at the Treasury that understand all this and will not do this. They won't do this. But that does not stop the fringe from talking about it. So maybe the talk by some elements in other places have gone beyond the realms of this sort of sober mind discussions. Now, the central bank itself should always remain ready, poised to deal swiftly with any shocks that may come, and relating to its mandate. And it should be free to choose the most appropriate instruments to deliver its mandate. And this is what we call central bank independence, right? This is why it is essential to have the central bank in a strong financial position. Otherwise, the central bank would be consigned to the uncertainties of crisis after crisis, right? So, I mean, as I said in the press release that we sent out, we did make the point that we had actually increased our paid up capital from 20 to 45. 35, 20 to 35, which was essential. And we have explained that in various ways. Otherwise, you have this crisis after crisis short-sightedness, and of course, the excesses of party after party swag. I rest my case. What else?
Njoroge from K24. My question is with regards to NPLs. Could you probably give us the numbers?
Alex Modi from NTB. My question regards your comment on the output gap. Maybe could you give some insight on what you think the challenge of pending bills has had with maybe the impact on that output gap, or generally the impact on the economy? Thank you.
Dominic Omondi, Standard. My question is with regards to what you've just talked about on fiscal dominance. Would you perhaps give us, even if it's not a real threat of fiscal dominance, have you any instances where there've been what I can say like perception of fiscal dominance currently?
Yeah, that's fine.
Njoroge from the Nation. So Treasury had asked for 25 billion. You guys gave them 4 billion. Do you equate the extra amount to printing money? And lastly, there was like an 80 billion injection in June to the money supply through other deposit at central bank. Could you please explain that to us? Thank you.
No, better.
My name is Bella from Bloomberg News. I wanted to know, given the market perception survey that you did, there's a lot of optimism in the banking sector. Are you able to have any indication of how private sector credit growth would grow now that the rate cap is out of the way? Do you see us playing in the levels we were at before the interest rate caps? Thank you.
Okay, let me first take this, if you don't mind. It requires some work, so if you give me space. First, Jim asked about the NPL. So the numbers that I have handy is really the overall numbers, where NPLs to total loans have come down to 12.3%. That is from 12.6. And actually, if you go back a little it was as much as 12.9. I think that's as far as it went, the highest. Now, I don't think that what you are after is just the numbers. And the numbers, please look at the press release, because I tell you, in there it says, it also mentions the sectors where this, I think the question, if you don't mind, I could expand it a little, which is this an okay number, right? Is that okay, Jim, if I ask that question? And the answer is no, it's not. Meaning, it is, the fever has broken, clearly, but you haven't gone back to more normal numbers. There's still a lot of work that needs to be done, and it is continuing with specific sectors, with specific, if you remember some time ago, I gave you even some, I stopped short of giving you names, right? I told you there some area in I don't know, in mining and quarrying, in trade, wholesale trade. I mean, the sort of institutions that are in those areas that have NPLs. But the point here is that the banks continue to work with them. And our expectation is that this, and their work, you can see, is already paying dividends. We expect also that when credit growth begins to pick up more strongly, or continues to pick up more strongly, the denominator will obviously become larger, and therefore the ratio will be coming down much more quickly. But we don't want to hide numbers. The point for us is that the NPLs, bank to borrower, needs to be dealt with. Okay. Alex asked about output gaps and pending bills. I think what I'll mention is, and maybe this is the opportunity for me to say a few things about pending bills. The government did make announcements last week about pending bills. And to this effect, there has been some numbers that basically, the government made the announcement, but also there has been letters that have been sent to all ministries and departments. They're called MDAs. So it's ministries, departments, and something. And agencies, okay. Now I knew there was an A in there somewhere. MDAs, right? So they were asked to clear their pending bills. And obviously, this is the first charge on their allocations for the year. That is what the PS and indeed the National Treasury has insisted with them. These are the pending bills that were at the end of last fiscal year. And if you want the numbers there, there's something like at the end of fiscal year 18-19, there were pending bills of something like 96.1 billion. And these numbers you probably know, of which 2.6 billion are for the vulnerable groups, the AGPO. I don't know if you remember the acronym AGPO. And the point here is that those pending bills to the AGPO should be the first ones to be cleared. Now, it doesn't mean that there is some sort of fiscal, let's say, everybody has been given free lets to do whatever they want with the pending bills. Of course not. I think the usual checks, the Ministry of National Treasury is very careful in terms of ensuring that these pending bills are truly pending bills and not some fictitious pending bill that has been created by some creative Kenyans out there. So that is one element. The other element, of course, was the communication that was sent to county governments. And they, as you know, have pending bills At the end of June 2018, they had pending bills of 89 billion. The Office of Auditor General had numbers like that. And some of those have been cleared, but there are still a lot, an overall number of something like 64.2 billion pending bills from counties or by counties. So you can see the problem is large. But these need to be cleared, and the government instructed the MDAs to clear them by the end of November. And also the counties, they've been asked that they should clear their bills and or significantly pay the pending bills and indicate the National Treasury or indicating it to National Treasury. Otherwise, the National Treasury will withhold their shareable transfers. So the point is that government is now really focused on pending bills. What is the impact on that? Now, I'm delaying the answer, Mr. Alex. We did not do what you're asking, and I think we'll do it in the future, which is to see the output gap. What do you ascribe it to? Do you ascribe it, let's say, to pending bills, or do you ascribe it to all the other things that you could break it down? We didn't go that far. But what is clear is when the pending bills were paid in June, July this year, there was actually significant, let's say, calm that settled in the economy. And I think that was picked up in the MPC market perception survey that was done soon thereafter. So we would expect that there'll be actually, and I hope that you are the ones who are closer to the population, how things are as these pending bills are paid. So that's all I can say, Alex, about that. Dominic asked me about fiscal dominance and perception. I would actually answer a different thing. Obviously, even this thing of interest rate caps, you're asking about perception. That was one of them, where you could say that the focus on, the idea of shackling the central bank and monetary policy in a particular way, that actually obviously was thoroughly, let's say, problematic. And we have made those points before, so I don't want to repeat that. But in terms of central banks caving and, in a sense, getting obliterated by fiscal dominance, I'll just ask you to look around. I don't want to point out my brothers, my peers around the world, but just you do a Google search of central banks that have come under pressure, and I'm sure you'll have, within 3 minutes, you'll have at least three significant institutions that have come under pressure. And I think this is something that we should, as a people, should protect. It is an institution that is there to protect us at all times. And I think we weaken it at our own peril. And when it needs to act, it will not be able to act. And that's the futility of this. I'll give you an example, Dominic, that I was preserving for somebody. There's a story, a fictitious story, of course, completely fictitious, of a head of state who wanted his country to make a mark in space travel and exploration, right? And so he says, other countries have gone to the moon and Mars. You know the story. Gone to the moon and Mars. We'll be the first nation to send a man to the sun, he declared. Later on, his officials told him, sir, this is an impossible mission you've set for us, because the sun will burn and destroy anything, that comes near it. So, that's not a problem, he retorted. Send the rocket at night. I think you understand what I'm getting at. And I think at times we are like that, where a lot of hubris, but the reality in the end will stare us in the face. Then we had a question about by Gunyunyu. I did not understand your question, Gunyunyu. You said something about 25 billion. We were required, we were this, we were that. I don't know what that is about. So what I would ask you is read our press release. Our press release is very clear. Oh, you're on that side. You are over there. You're standing over there. Okay. So I don't know what you meant by all that. Who requires us? If decisions are made in some, let's say, in some forum that smoke-filled rooms by people who do not who want to send rockets to the moon and to the sun, well, I think we end up in that sort of situation. I think what is clear is what is in the press release, which is we follow our specific law, the law of the land, to the letter, and we've done that for 54 years already. Most of us were not born 54 years ago, but we've been doing this. So if there's anybody who suddenly seems to know these things better, well, then they need to revise the 54-year history of the central bank and indeed other central banks. By the way, in the end, at the end of this, we did make the point that this is aligned to the practices of the global best practices of central banks. So we are not doing anything that is, let's say, some sort of sleight of hand in this maneuver. Vera asked about optimism in the private sector credit. I think I would say a couple of things. It's true the private sector credit number is now at 6.6. I think that's the number. Obviously, we're expecting it to be a much higher number at the end of the year. But I think we are happy that now we don't have the interest rate caps. We are happy now that the bankers can actually do serious banking. We can have a conversation about banking. In the past, we were not having a conversation about banking. And therefore, we can talk about private sector credit. Secondly, which is an important thing, Vera, is to appreciate the changes that have taken place in Kenya in terms of the lending practices and the let's say, through the other channels that have been there. For instance, we now have all this. If you came to the launch of Starwi 2 weeks ago, maybe it is 2.5 weeks ago, I don't remember exactly when. It was in Safari Park Hotel. The president came to that. And there were, not only was there the launch of that product, the commercial banks actually were showcasing what their other lending products to SMEs. And that wasn't there a year ago. So there are many other products that are coming in. And in effect, this has allowed us, or would actually be something one would think about, maybe the ratios we used to have before, meaning the efficiency ratios. So what in the past was, let's say, 10%, and what 10% growth would do. Maybe it could get now, because of all the Finance Plus programs that are there, maybe it will not be 10 that is needed. It's a lower level of credit because of the support that is being provided. I don't know. These are the things that now we are learning, but definitely we are in new territory. And definitely this is more exciting. Definitely this provides possibilities that never before we had or we imagined. I mean, just think of the revolution that the mobile lending at small amounts, the small amounts that the mama mboga or the lady that goes to Wakulima market in the morning, think of that and see the impact that has had. So we as students of the economy are very excited to be at this stage, because I think there's so much that we need to learn. I think those are the questions that were there.
Good afternoon.
Good afternoon.
From Njoroge. And my question is on interest rates. A lot of work by the central bank with the CBK charter, cost of credit offset, quite a number of notable items. But our worry from where we come from, reporting and being on ground, how should we hold banks into account? What should be the manifestation? Should we see a return of the ones KBRR? I know there's also been talk of, can we just annualize everything, the different rates that are charged and put it all into the interest rate? I mean, how will you be holding banks into account in terms of what they charge? And again, noting that we don't want a blanket interest rate, we want it priced according to the risk and so on. How should we expect that to be manifested? Thank you.
Brenda?
Brenda Kirubo, KTN News. My question is in regard to the economy as a whole. Negative output gap. What exactly led to the weakening demand? And at the same time, even as you answer that, what worries you the most when it comes to the 2019 economy? We are now 1 month into it. Is it the fact that Treasury borrowed heavily in the last few years? What exactly worries you the most that really affects the economy then as you project in the last 1 month?
Pass it back to Brent.
My name is Kemani, and I work with the state broadcast. I have 3 questions.
Please, Brent, you don't just ask one, but we'll come back.
Well, they're all the same, so it's not a big deal. So the first question being, how much fund is being held by these state agencies? At all, you have any idea from the circular that was issued by Joseph Kenya? Then the other question in relation to that is, what would you expect will be the impact of these agencies missing from the paper market? And then, was there any correspondence between CBK and the executive before the circular was issued?
Just going back to the question you had about not going back to where we was critical for the commercial banks in terms of measurements. Apart from them just being asked to behave themselves, what do you have in your toolbox to actually rein them in so they don't go back to the behavior they used to have in the past?
My name is Faith Tete, Zalendo News. My question goes to the status of banks still under liquidation, including the Charter House borrower.
Thanks.
Okay, so let's deal with this. KEFA, I want to be absolutely clear. There's no such thing as KBRR. I don't know what happened with KBRR. It doesn't exist. I don't know, if you are like me, you went to primary school, you used to wear those short pants, right? But I'm pretty sure today and now, if I saw you wearing short pants, I would laugh. You understand what I'm saying? So please don't take us to the regime of the short pants. I hope I've made my point very clear on that. It was a crutch, and we should accept it as that. So this is a modern economy that you are holding to some thing that was cooked in a rush somewhere. You need to free the economy. That's the way we need to, that's when the benefits will best come to us. But also, KEFA, and this is more to George, deep water is not synonymous to drowning. You have to appreciate that. Yeah, today I have a lot of analogies, okay? Deep water is not synonymous to drowning. There are those of us that believe, because I cannot swim, I believe that if I stepped into water, I'll drown. And that's, I think, the fear that some of us have, right? The fear of letting the interest rate regime operate. Because we don't know. It's not that we don't trust it, but we don't know. It's not, you cannot tell me I don't trust the water. It's just that I'm afraid of being in the water because I believe I'm just going to drown. So I think here is where we need to do that education. And this is what we started doing. So George, I would encourage you to read my op-ed. I know Reuters doesn't do it. You're not Bloomberg. Bloomberg actually puts out opinions. I'm swinging at Bloomberg now. But I'm just making the point, read that argument that we put out there. We make the point that it's not just about moral suasion. The way you tell a bank, do the right thing. We've asked them to do certain things. They've already given us a plan. And we are going to hold them accountable to that plan. That's a plan that has gone to the highest authorities in that bank, right? The board, they've signed off on it. So by the time you have all the way to the person who, let's say, serves you at the, at the booth, the cashier, when you go to cash a check or whatever else it is, whoever it is, all of them should really be singing from the same hymn book, which is the one that actually the board and, should we say, the bank itself has instituted and explained to the central bank, this is how we're going to be dealing with it. You talk about, see, it's not just about pricing, and this is an important element. It's not just about pricing. Some of us are just fascinated by pricing. And we've made the point, no, it's not just about pricing. It is actually, it's a complete package. And I mentioned the 4 pillars. And we've worked, and in the various things that we've explained how each pillar is being brought forward. So for instance, in the one about ethics, which I didn't say too much about, we did say that we expect shareholders to be more accepting of lower returns. I think we made that point. What we mean by that? Remember the race, the beauty race that takes place, the beauty, contest that takes place? So they begin, one bank has returns of 22% profits. And you guys, I think, encourage it. So headline, Bank X, 22% growth. You know the next bank will come out with 23 or maybe 22.1, which is higher than 22. And you can imagine the CEO the night before is saying, telling the financial guy, let's see how to increase this. Surely, find a way. Find a way to make it higher than what was in the newspaper. I mean, that is the race that is driving us where we are. Frankly, that is the race to the bottom. And that's what we should stay away from. So we've made the point that bankers, shareholders, should be more accepting of rates of returns that are much more, let's say, in line with peers around the world. I mean, we have 30%, it's come down to 22%, but it's still much higher than everything else around here. I'm talking of other countries. So that is the point. Does this happen? Do you actually just flip a switch and everything is okay? Of course not. And that's the discussion that we've been having with them. So I hope I've answered both your questions on this. So how we are going to hold banks into account, we've explained it. Not only will we be talking to them about what they told us, but we'll be going back to them again and again. So it's not one sort of, let's say, decision, and then we sign off on it and all that. No. It is actually a continuous decision. Now, on your side, you should also hold the banks accountable. Don't just walk away from them. Hold them accountable. What are they doing for transparency? When you go to borrow, or even find out, do mystery shopping. Maybe you should join us and do some mystery shopping. We've done mystery shopping a few times. No, I'm serious. These are things we need to work seriously on. That's the only way we are going to hold them accountable. Don't write articles that are just, what they feed you. Do the mystery shopping and find out, are they actually lending at that rate to you? And what is you talked about the overall, APR. What is the overall APR? You can ask all those questions. And so I think the point is we want to empower the consumer. The consumer must be empowered, but the consumer will be empowered with information. It is information that makes the consumer really the number one in all this. And the consumer here, I mean not just the borrower, also the depositor. So I think it is important to understand it that way. Brenda asked about the output gaps here. I don't want to say too much more about the output, why the output gaps and all that. I think you already have some sense about this. First, think about agriculture. Agriculture, the rains, for instance, were late, and also are insufficient. So that's why you could say for agriculture, you could explain the decline, right? Then others, partly is lack of credit. I think we've talked about that. But I think a significant element of that is the SMEs. The SMEs. The MSMEs. And I think we've talked about the problems of the SMEs. If there is any institution that has been plugging this from the beginning, is the central bank. And you can look at the record. I mean, we've been really pushing this because this is really what is going to push the country forward. Now, we should also appreciate that SMEs doesn't mean dirty jua kali operations. But on the other hand, wherever they are today, that's where it is at, right? I mean, my friend Daniel, I mean, young what? He's 25? 25-year-old young man. And I think about him every day because this is a man who is out there, right? He's out there in the wild, as it were. And who knows what is going to drop him today? Is it a carjo? Is it the somebody robs his things? I mean, this is, you're asking me about the things that are problematic that worry me the most in 2019. It's precisely the SMEs. That we haven't done enough for them. That's what worries me the most. We started, yes, of course we did. You saw me in all these places. And we've gone back there. I don't always tell you when I go back there. And maybe we shouldn't. But I think my issue is that those SMEs, they don't have much scope. They don't have much space. I mean, you and I can survive for 3 months. You know, I mean, you could be fired and for 3 months you'll be okay, I'm sure. There are others that will survive for much longer. But the SMEs, Daniel told me that he isn't even sure where he'll be at the end of the month, was it? Or the end of the week. He wasn't sure. That's what bothers me. I mean, that's what worries me the most. And what does it do? I shouldn't just stop there and sort of worry about it. No, I think this is why we feel so strongly about the SMEs. Because if it begins to turn, all those people, and indeed the economy will in the end work out, right? You talked to me last time about your grandmother. I mean, at the end of the day, that's why we go to work in the morning. It's because they are human faces to everything that we do. That's really the issue. Okay. Kimani asked about the funds. I don't have the numbers as such, but I mean the final numbers. But I think, yeah, I don't have them. Oh yes. Thank you. Yes. So all I can tell you is that the numbers are around. So state corporations are holding something in the order of 186 billion in government securities. 186.6 in government securities, T-bills and bonds. So that's about 5%. Actually, it's a little. It's about, this number is about 7% of total stock, right? So that's the number. You asked about the impact. I already explained. The impact will be negligible. I mean, 6% is perfectly, we can consume 6% and not even taste it. So that's not an issue. In terms of communication, I think suffices to say that we are in constant and regular communication with the National Treasury on matters relating to government financing. After all, we are the fiscal agent of the National Treasury, and also on matters that may relate to our monetary policy. So if there's an issue like this that indirectly may touch on monetary policy, of course we have that conversation. George answered. Faith wanted an update on banks under receivership. Okay, so I don't have much of an update except to say, okay, so first on Dubai, I think you know that is it's already under liquidation, it's moving along. Imperial Bank, we are still in this state of It is under receivership, and the issues there were just to make sure that we have, the current situation was to make sure that Kenya Commercial Bank, KCB, can actually provide some of the access or disbursement to the some of the Imperial Bank customers. That I think is on train or should have been completed a few days ago. If it has not been completed, I didn't check this, Faith, so I'm sorry if I cannot give you more details on this. But then on Chase is also in the same league. Chase, what we intend to do is to do an audit. We need to have an audit to figure out what actually happened, because remember, this was an institution that was working as a bank, you remember, even after the receivership. So it is important to have an auditor go through it and sort of give us a report as to what happened during that period. And so that's what we intend to do before deciding on the next move. On Charterhouse, that is a sore point. That is the equivalent of a body blow. Basically, that has been in the works for more than 10 years now, and we need to figure out what to do with them. So I'm not saying that we are done with them, but all I can tell you is that we have been working, but perhaps been distracted by other things. So now that we hope other distractions become less and less, we can now concentrate on some of these things. We do understand the cost to the population. And as I have told you before, we are human beings. We do see the cost of it in terms of the people's lives and families and things like that. But at the end of the day, we need to do the right thing in terms of, globally, not for individuals, but for everybody. So I think that's all I would want to say. And I'm sorry I don't have any more to say, because I didn't come more prepared for this. I came more prepared for a different fight. Okay, what else?
Any last ones? So Dominic, so any first round questions? None. So we'll just take those ones. It's already 12:30, so I think it should be the last round. We'll start with the theater at the back. I'm here. You already have the mic. So whatever.
Dominic again from the Standard. The IMF delegation in their report said that early next year there will be a time again for another discussion, this time round on another precautionary facility. Would you kindly tell us the nature of the precautionary facilities that we are looking at, and when is it that they are coming next year?
It answer my question about the 80 billion that was injected in the money supply and other deposit at CBK in June. And then my question is, we are not talking about the elephant in the room is government securities. We've already seen kind of a bidding that is pushing up the rates of the short-term papers because banks are underbidding. And do you think, and we saw revenues fall by 60 billion and expenditure increased by around 2%. So do you think that, how big of an impact do you think that will have on the pressures for interest rates? Because banks can't give us a lower rate than risk-free government paper.
All right. Was there someone on this side? No. So just, I think these two.
Okay, fine.
Afternoon once more. My question goes related to Otiatos. It's on what you read into the fiscal stance going forward. You say the guy is much better. Certainly it's much better than where we were a few months ago. But again, it's the same expectations versus what's on the books. There was a slippage of widened even deficit in the first quarter from the review paper. And the worry is again that the same gap is always usually filled by domestic borrowing.
Okay.
Do we risk going back on the fiscal side to the same?
Okay.
All right, give me the mic.
Governor, slightly different questions. And the first one being, the BBA report is being released today. In terms of early
The what?
the The BBI report is
What's
being released
BBI?
today, the Building Bridges Initiative.
Oh, okay.
Yes. So, in terms of throwing the country into political mood, what does that mean for the country's economy? And the other question is with regards, when you look back at the year 2019, was it a good year financially,
Okay,
given
I hear you.
that we're struggling, and why?
Thank you.
If it was a bad year, why?
Right. There are no other
Yes, they did say, maybe to put it different, first they did say that they have been here and they spent some time looking at some of our numbers and things like that. And they actually spent a lot of time with our friends in the National Treasury, because the concerns before, I mean, the areas where things have changed the most is in the National Treasury. I think we all understand that. That's not a mystery. And in terms of the policy stance, where it has changed the most is obviously with regard to the National Treasury. So they spent time with them. This was a so-called staff visit. And the IMF, yes, does visit countries every now and then. And we actually requested them when we were in Washington. We requested them to come. They hadn't been here in more than a year. So it was actually important for them to come, so that they understand where our numbers are. Otherwise, we'll end up, being overtaken by events. And then you're arguing about things that happened a year ago, and you say, where were you when we were doing this, right? Just like your own neighbor. I mean, you have conversations, as they say, good fences build good neighbors, right? So build those good fences together. That's why so that's what we are doing, right? I think you understand my context there. So I think there were very good conversations, very good conversations. Was the conversations, did we finish on everything? No, of course not. But I think in terms of openness and understanding where the economy is going and all that, I think the general, let's say, broad brush strokes are clear, and so that wasn't the thing. That wasn't a concern. So they intend to come back when we invite them, which is most likely early next year. Mind you, they can't come without being invited. I hope you understand that. So they cannot I cannot come to your house and just demand to see what you're cooking. It doesn't work that way. You invite me and we have a conversation and all that. And we have made this point again and again and again, that it is in our interest to actually get some insurance, because the shocks can be large. And we will get insurance. We intend to get insurance for our sort of large external shocks that may take place. That's really the point. Some of the shocks we can deal with. The small shocks, external shocks, we can deal with that. We have reserves, we can tighten policy, and other things. But eventually, if things really go south and the sky falls on our head, in a manner of speaking, then we would need to have to draw on this line of insurance. That's really what it is, a precautionary line. In terms of the details of that, obviously there are no details at this moment. We will, but what we've made the point that whatever we do, it is our policies that we have been put together. And this, I think, is important for you to explain to your readers. At the end of the day, we want to be our own masters, right? Like that poem, right? We are masters of our own fate. And that's what we intend to do. So we know what we need to do on the monetary side. We know the monetary policies that we need to. So this, let's say, precautionary arrangement will support what we intend to do. On the fiscal side, now they are much clearer what they intend to do. And I'm going to answer those questions in a minute. So it isn't, you should do this, you should do that. Maybe they are going there already. And so it is supporting that. For instance, the strengthening of revenues. I mean, frankly, they've made the point that they need to improve the revenues. And I'll come to that in a minute. So I think that's the context. I hope we can leave it as that. Maybe I begin with the deficit. It's not the first time we've had a conversation with National Treasury. I've been here 4.5 years now. It's not the first time. But I think it's the first time, maybe it's a couple of MPC meetings before, that actually we signaled that the believe in the fiscal consolidation that was taking place. I hope you saw that. Meaning, it's one thing to have words that we are going to consolidate. It's another one to actually mean what you say and actually go ahead and do it. And as you try and do it, maybe you'll fail in one area or the other, but you know that you are fully aligned to the outcome. That's really what it is all about. So, coming to what you're saying, I think there are several things that have happened. And now I'm talking about the material that was presented to us from the National Treasury as we considered this thing yesterday, as the MPC met yesterday. First is the clarity in terms of revenues. Revenues in the past were overstated, completely overstated. Gunyunyu keeps telling me about what 5.8, 3 point this and the other. I don't know where those numbers came from, frankly. So you could put it in a budget, you can put it in whatever and it looks good, the total looks whatever, but if the central bank isn't going to give, I mean, you could say it is dividends from the central bank, whatever the number is, right? Well, you want 100, well, pad it, give it 100. You understand what I'm saying? If that's the way you do budgeting, then you deserve what you get, which is nothing. And indeed, you deserve the crisis that follows after that. So I think the point I'm making here is that they went from the ground up, looking at revenues. So even though there are certain revenues projections that were there, they began to look at the realism of those projections. And they have revised their numbers appropriately. We are talking 18-19, fiscal year 18-19. Secondly, on the KRA side, they are looking at how much revenue they can collect, meaning what is the effectiveness of the systems that they have and all that. And I think you've already begun to hear a lot of noise of people who are under pressure because they've not been paying revenues or taxes, and now they're under pressure, right? And all that. I mean, obviously, it's amazing how you can lose 1.5% of GDP in 1.5 years in terms of revenues. I mean, that just boggles the mind. But it happened. So I think the point I'm making is the issue of credibility. Strengthening things, strengthening fiscal, not just randomly having a nice number or a nice table that has everything all lined up, but actually going line by line. That's what the current, let's say, the people in the National Treasury have done. So they started from zero building it. Now, that's on revenues. Then you have expenditures. Obviously, what may have been happening is that revenues are overstated. That allows the budget to be overstated in terms of expenditures. And then when the revenues, so you start at very large numbers, and when the revenues don't come, what happens? You just cut back dramatically. So it is this sort of feast and famine, crisis and crisis to party after party, exactly that. So I think it is that sort of maneuver that we need to deal with. And maybe some of us like that sort of crisis. We get a high from all this sort of going from side to side. Most of us don't. So let's stick to proper planning. And frankly, we are not the first country, and this is not the first year for us to do this. We've been around for 50-something years. So I think it is important to sort of go back to the traditional fiscal sort of discipline and budgeting that is required. In terms of the consolidation, yes, there is actually a reduction in the deficit that they are looking at from 7.7% to 6.3%, if I'm not mistaken. So that is a substantial consolidation. The number I gave you, 1.8% of GDP, that was actually a consolidation in terms of the primary balance, which is another measure, but I wanted to confuse you a little in this. So that's, I hope that makes sense in terms of this. So we are much more hopeful that this will be implemented as planned, as opposed to let's wait and see. So we can already begin anticipating that there will be a consolidation, which is what the MPC did. Fine. Gunyunyu was asking about the pressures on the market, and I want to answer it a little different. I don't know about interest rate pressures, what you call interest rate pressures in the, there are only two markets that we are talking about. One is the T-bill market, the government securities market. And the government supply, the demand for financing in the government securities market is fixed. It's actually 300.1, is it 0.1? 300.1 billion for the year. So that's fixed. No matter how much you want to lend the government more, it won't take any more. You understand? Remember there was a time we were talking about the government is going, I don't know, maybe this is a caricature, where you think of the government being drunk, you know, and it wants more, you know, more financing. It has more expenditures than it has financing, right? So whatever you can throw at it, it's just gonna tick. That caricature doesn't work. The point is that there's a fixed, let's say, demand. In this case, it is 300.1 for the fiscal year. And that's what will be done. We've already done a lot of it so far. So I think the point here is, even though banks or yourself or some external investor or whoever else wants to buy T-bills, you know, you cannot buy beyond what, or government securities, you cannot buy beyond what is being put out as demand by the government. Now, what has also happened, which is what maybe some of the commentators don't get, obviously there are times when, you know, think about December. What happens in December? There's a lull, right? Things calm down, you go on vacation, I go on vacation, the banks go on vacation, so things quieten down. So December, January, things are quiet, right? And then they pick up later. So there is seasonality, you understand? So actually, there is seasonality also in our borrowing pattern. So there are times when you go ahead of the, let's say, uniform run rate, right? So, and at this moment, actually, we are ahead of it because we expect December will come down. You know, there'll be a time when things will be a bit calm. So that is the thinking we have. So I think it is completely different from the caricature painted, or maybe more towards your question. Now, it's true there has been sometime in June, more like July, there was an injection of significant amounts, and this related to the pending bills. I think we've talked about that before. Now, the pending bills, once they leave the government's budget or the government's accounts, they end up going to people's commercial banks, right? You are the one that is being paid. Then it is your decision what you want to do with the money. You can repay your bank, you can keep it there as a deposit. I mean, that's your own personal decision, and nobody will hold that against you. Now, we do have questions about some of those, because we've actually seen that all the money didn't move as quickly as we expected. But that's a separate question. I mean, those are the questions that we are looking at more than anything else. So I hope I've covered that. I think it was Jimmy who had two questions. He explained to me what BBI is, but that's okay. So I cannot tell you anything about the political side of this. The only thing I can tell you is we are benefiting dramatically from two things that you and I probably take for granted. One is security, and I'm talking of fiscal security. Remember when there are all these problems when in 2015 with the Garissa and all those other things, right? And that sense of Kenya, it led to the statements by some famous statements by some people about the sort of how things were here in Kenya, right? Insecure and all that. But I think the point I'm making is you and I probably at times take that for granted, that things are now secure. You know, you can travel without much concern of security. That is a major benefit for the country and indeed for all of us. I mean, tourism is back, and many other things. Even when Dusit happened, on January 15th, I think it was. I mean, very quickly that was seen as an aberration, and we moved on and so forth. That's one. The other one is what I would call, just let's say, just a good political environment. And I think when we were going towards the elections, I think there were concerns. And I think a lot of us as people, as Kenyans and so forth. But then when later on, when the calm restored, and I guess then we called it the handshake. Actually, on that particular day, when there was that major announcement, you could have felt the calm, in the city. And a friend of mine told me, I mean, he called me and all that, within half an hour, I mean, the mood had changed in the city, here in Nairobi. And I'm sure you are much more perceptive than me, stuck in rather, let's say, in the corner, in many ways. So I think the point for me is that at times we take those things for granted, but they are essential. They are essential for the economic development and indeed the economic well-being and our way of life as Kenyans. And I think we shouldn't not only shouldn't we take it for granted, but we should actually, in effect, improve on it, sort of reinforce it as opposed to, tearing it down. Now, whether it is whatever it's called, that's not my domain. All I can tell you is, for all of us as a people, we need to support those positive outcomes which are for ourselves and also for our future. Finally, you talked about 2019. What was your question about 2019? What are the?
From where you see, was it a good year? Why?
You asked me as an economist, but less as an economist and more of a central banker. I have already told you that central bankers are the only people in the world where you could walk with them and you say, Governor, it's bright out there. Look at the sun. It's nice and bright. And I'll respond to you, but it might rain this afternoon. So in a sense, we also look at the worst case scenario. But I am not going to give you the worst case scenario. I'll give you my sense of assessment. 2019 was a difficult year. Very difficult year. Maybe we've had other years before. But first and foremost, the issue of the interest rate caps. To me, that really grates at us because we lost so much. You're asking me about that output gap, Brenda, output gap. A lot of that is actually the interest rate caps. So we lost a lot. We could have been much further ahead. You talk about SMEs. We've lost a lot of GDP, if you want to think of it that way. And we've lost a lot in terms of human outcomes, positive outcomes, which is where we need to go. Brenda, you asked me about your grandmother. Exactly that. It's those things that we have lost. Now, I guess these are lessons for us, right? These are lessons for us going forward. That's one thing. The other, so it's a lesson for us, and that's why we are really pushy in terms of SMEs. And we are pushy about all the things that we need to do well. Secondly, I think we've also learned a lot in terms of our fiscal position and how to do fiscal and things like that. Are we, is this done and dusted? Obviously not. But I think the usual paradigms of good fiscal management remain. And maybe we deviated a lot from it. Not just maybe, we did. Let's call it for what it is. And it's only now that maybe the chicken are coming home to roast. But it was there. We did make those statements. I've made those statements in various things. Just go back to the previous statements. Now, maybe I didn't wave a red flag in various ways, but if you are wearing the right glasses, you'd have seen the flag was red. The point I'm making is we are going back We are happy now. We are going back to implementing proper fiscal and indeed more macro management from that perspective, right? So things about not just the budget, things about the deficit, things about, none of you asked me today about debt, debt issues and things like that. I mean, we cannot, there was a lot of abracadabra. I don't know if you understand what I'm saying by abracadabra. Yeah, there was a lot of that. And we need to do the right thing. Forget the abracadabra. Let's do the heavy lifting. Pure economics, pure people that we are dealing with. I mean, the demands are so great. Look at the hospitals. Look at the schools. Look at the roads. We haven't even talked about climate change. I mean, the demands are huge. So that's another point I'll put on the table. The other thing for me is the potential. There are two other points I'll put on the table. The potential for our banking sector. Meaning, it's true we beat them up, and the population beat them up quite hard, and I think maybe they deserved it because of the excesses of the past. But I think they are now able and willing to actually begin to serve Kenyans as they should be served. So to do serious banking. And I think if you talk to them, you'll see that. You'll see that they actually no longer sort of the old, return is, bottom line is king kind of thing. There are many concerns, and they've done a lot of things. I would encourage you to see what is it that they've done. For instance, all the things on the products that are meant for the small and medium-sized enterprises, right? There are products for, I was watching some things from one of the banks has a program for data, which is what? I think, well, I don't want to say the company, but it is for women and all that, yeah? And I actually listened to a lot of the conversations in that space, from an outside. They didn't know I was listening in. And I was actually very impressed by what they are doing. And there are the standard things that have been going around with other companies or other banks. So my point is, I feel excited that there's so much potential that now we can exploit we can actually benefit from in 2020. I said there are two things. The other one, I'm saving the best for last. I happened to travel to Singapore 2 weeks ago to attend the largest fintech festival in the world. 60,000 participants, 1,000 plus exhibitors, and we had our own Kenyan stand there. As I have said, that it was, in my view, an unqualified success, Kenya's involvement in this. I mean, we excelled on that stage, in the national stage. So this is the equivalent of going to, I don't know what the equivalent is in your professions or in your areas, So the mecca of that, fintech. What is interesting, so it was interesting to be validated, the things we are doing here in Kenya, the fintech things that we are doing, validated, accepted, and a lot of excitement about them, including mention in the keynote address by the person who was giving the keynote address, who happened to be the Queen of the Netherlands, who obviously has expertise in this area, but mentioned Kenya, many times as the example, raised it as the example to follow in many ways. And that speech is somewhere, I'm sure. But the best part of this was we also took 2 teams of young entrepreneurs, or not entrepreneurs, innovators, and they were going to participate in the hackathon this is the global hackathon. So they come from all over the world to that one. And we had 2 from Kenya, 2 teams from Kenya. Somehow, being typically Kenyan, we got a third somehow between here and between Nairobi and Singapore. Don't ask how. So when we got to Singapore, we were 3. There were 3 teams. And those 3 performed amazingly well. They were in the top 20, all 3. And one of them was in the top 3. My point is, these young people proved that they can actually not just operate, they can hold their own on the international stage. So my point is, I was of course completely ecstatic. I was very happy with this, you know. But I think the point I'm making is, it is those sort of trends you see, and you realize that 2020 and whatever is going to happen in the future is going to be amazing. So not only is 2019, have we learned from 2019, it sets us up amazingly well for an amazing 2020. So thank you very much for your questions, and I look forward to seeing you in the future. If I don't see you before Christmas, have a Merry Christmas.
Right,
That's
so
it.